Today I want to talk to you about the topic of stock splits. What actually is a stock split? What does it mean for us as investors? And how can it potentially impact the stock price of a company in the future? And what better example than talk about NVIDIA, which is actually about to do their own stock split on Monday. So it's a great time to talk about it and see what it means for you and whether it makes the stock more attractive or less attractive. Let's talk about it. Right, so in the example of NVIDIA, right now, one single share of NVIDIA stock is costing $1,200. So that's quite expensive, right? And probably too expensive for a lot of people, especially beginners, when you want to start investing and you want to buy and own a full share. That's a lot of money to spend. If you just want to, get invested with $100, $200, technically you couldn't buy that, right? While at the same time, a lot of the new brokers, they do offer fractional ownership. So you could buy half a share, for example, for $600. But still, a lot of people, psychologically, when they see the price of one share, they think it's very expensive. But I'll come to this in a second, because that price alone really doesn't tell you anything about the value of the company. What is important is the market capitalization, which is this number over here, 2.97 trillion. And it says over here, market capitalization is basically the price, the $1,200, times the number of shares that are in circulation. So that price times all the shares, how many millions or billions of shares in circulation, those two multiplied together gives you the total market capitalization, the value of the company, so to say. And that's really an important number to keep in mind, because that in a way tells you how valuable the company is relative to another company. So you can see, for example, here, the largest companies in the world, as a global ranking actually, compared to each other. And right now we can still see Microsoft being the most valuable company in the world, but second is Apple, which for a while was actually the most valuable company. But then in third space, we have NVIDIA, which, as you can see over here, just dropped because actually for a few days, it was second most valuable company. They've really been performing extremely well. I mean, look at these numbers, very small differences between each other. So personally, I wouldn't be surprised that after the stock split, we might potentially see NVIDIA jumping onto the first spot. But again, something to be seen and something we'll talk about in this video. But yeah, just keep in mind that the market capitalization is much more important than just the pure share price we've seen over here by itself. That's just an indicator, it's just part of the equation, but not the most important part. But let's have a look how a stock split actually works, right? Let's imagine you own 2 shares of NVIDIA, which is valued one share at $1,200. So in total, your portfolio would be $2,400, right? That's pretty straightforward. That's what's in the past. Obviously, if the share price continues to grow, you will still have the same number of shares. So if the price now goes to $1,500 times 2 shares, your value will be $3,000. So that's pretty straightforward. So what does a 10-for-1 stock split mean? So that's actually what you should keep in mind. It's a 10-for-1, because some other companies in the past, and we'll come to this a little bit later on, it's quite common for these stock splits to happen. And some of them go for 7-to-1, for 4-to-1, 2-to-1. So whatever the number is, that's something you need to keep in mind as an investor. So in this very example for NVIDIA, it's a 10-for-1 stock split. And basically what it means is that they're going to divide the price that is currently $1,200 by 10. So now one stock will only cost you $120. But of course, you'll be very upset, right? If you open Monday morning your broker and all of a sudden you see the value of your stock price collapse by 10 to only $120, you'll be very upset, right? But don't panic. So while they divide the share price by 10, they will also multiply the shares you own by 10. So, the value will be less, but the total number you own will be more. So in total, the total portfolio actually will not change at all. It will still be the same number, just a lower price per share, but you will have more share. So you're still going to have the same portfolio value than you had before the stock split. While it might seem a little bit complicated and overwhelming at first, actually, there's nothing for you to be done. Everything will be done by your stockbroker, so you have nothing to worry about. So as soon as the stock markets will open on Monday morning, that change will have been done. They obviously worked on that a while ago. On Friday, at the end of the stock market, they made all the final adjustments. And on Monday, once the stock markets will open, the stock will trade at $120, obviously a tenth of what it was before, but the number will be 10 times more, which also means that the market capitalization, that number over here, the 2.973 trillion, technically will stay the same. There's no difference. Obviously, if the stock becomes more popular now, it will go up, yes, but apart from that, technically it will have exactly the same number. As I said, just a lower stock price, but more shares in circulation. Now you may ask yourself why companies are actually doing it. And there's a number of reasons. So the first one has to do with accessibility. Because a lower share price makes it more attractive, more affordable for people. Even as I said, it's actually just psychological because technically you can buy fractional shares, so you don't have to buy a whole share to be an owner of the company. But still, a lot of people, they see the share price and they think, wow, it's quite affordable. NVIDIA costs $120, while Amazon, for example, costs $184. Well, in this case, let's go for NVIDIA because it looks cheaper and everybody talks about it. Even though in many ways you have to look at other indicators, earnings per share, price to earnings, market capitalization. So there's so many factors on here because you don't see the number of shares in circulation. That's important to consider when you look at that number. But still, a lot of people only look at that, and that's actually one of the big reasons why companies do that. Another reason has to do with liquidity, because having more shares in circulation means there's more liquidity, right? That can be traded. Imagine a company only has 5 shares, right? I mean, if those 5 people don't sell, there's zero liquidity, right? Now imagine a company has 1 billion shares. There's always going to be some people buying and selling. So you have more liquidity, and more liquidity brings more trading activity, and that can only be good for a company, to be seen and so forth. So yeah, you want to have liquidity, and obviously having more shares leads to more liquidity. And funnily enough, as you can see over here, there was a research done in the past that found out that companies that do a stock split once in a while actually seem to be performing 25% better than the S&P 500 in the following year. So that's another reason. It just shows you that, those two factors, accessibility and liquidity, can definitely lead to a better performance. Not necessarily, but on average, that's what the study found, and that's something to keep in mind when we as investors make our decisions. Now, what does it mean for us as investors? As I just mentioned, your value of your portfolio, if you already own shares in NVIDIA, it will stay absolutely the same. Nothing will change to it. As I said, you will only have 10 times the amount of shares, but the price per share will be 1/10 of the previous price. But of course, you have the psychological effect because lower prices will bring in more people that think, oh my God, actually NVIDIA is not so expensive. Let me buy a share in that, right? Because not everybody is following the stock market, right? Right now it's hot because it happened, but a few months from now, people never knew about the stock split. They just see the price and I think, well, that's much more attractive than some other company. And think about it, Berkshire Hathaway, one of the 10 biggest companies in the US, run by Warren Buffett, the famous investor, one share costs $622,000. I mean, it's unbelievable. And yeah, I mean, not long ago, a couple of years ago, it was, only $60,000. Even back then, it was crazy expensive, right? If I go into stock splits over here, they've never done a stock split in the history, and he does it very purposely. However, let's look at some other companies, such as Apple, for example, right now at around $196. But when we look at stock splits over here, you see that they had a number of stock splits over the years. You can see over here in 1987, they did the stock split, their first one, 2-to-1. So basically the price was cut in half, but you would get twice the shares. Then back in 2000, another one, 2-to-1, then 2005, 2-to-1, then in 2014, a 7-to-1 stock split, quite an odd number, but that's what they felt makes it the most attractive and so forth. Because also you don't want to have a 20-to-1, right? Because that may not sit well with people. So the most I've seen usually is a 10-to-1. You rather want to do it more often than once every 20 years, but then, a 30-to-1, it just doesn't make sense. So up to 10-to-1 is usually the most people go for, depending on how much the share price has been appreciating, obviously. And then most recently in 2020, a 4-to-1. So a lot of people don't even know about these stock splits. They just see the price and think, well, it's very attractive. But as I said, it's just part of the story, right? And you see, for example, Microsoft right now at $423. So honestly, I wouldn't be surprised if soon they do another stock split. The last one was back in 2003. But you see, previously, every so often, they had a number of splits over here. One was even 1.5-to-1. So again, different percentages, but usually not more than 1-to-10. That's not common. So yeah, the last one back in 2003. So I think as the price of Microsoft continues to increase, they might do the same story like NVIDIA is doing now, just to once again be perceived more attractively and have more liquidity for stocks to be traded on the stock market. And of course, even NVIDIA already has had some stock splits in the past. You can see they started having the first one back in 2000. That was a 2-to-1 split. Then another one, 2001, another 2-to-1 split. Then 2006, 2-to-1. Then 2007, 21. And now most recently, 10th of June, which was last Friday, a 10-to-1. That was the highest one they've had because of the crazy appreciation in price in recent times. That's why they had to have an even higher number over there. And yeah, obviously, as I said, on Monday, once the stock market will open, that price will be reflected. Instead of $1,200, the price per share will be $120. So what's going to be the impact of that stock split on the price, in this case of NVIDIA? Now, personally, I think in the short term, it might actually bring in more new investors. Right now, anyways, NVIDIA is already so hot, right? That's why they're splitting it. Plus now that the share price is supposed to be much cheaper than previously, previously, a lot of new investors might see that as a buying opportunity. They'll see, wow, 120 per share, maybe I'll just buy 5 shares, which previously with that amount, they couldn't even own 1 full share. So I think a lot of new investors who believe in NVIDIA or want to jump on the hype train, they might get in right now. So I think in the short term, that might actually bring a little bit of price appreciation. Plus the fact that the study I've shown you over here shown that in the past, companies that have done a stock split usually see an increase in share price over time. And more importantly, with more trading activity due to higher liquidity and of course excitement with lower prices, more people getting into the market, I honestly wouldn't be surprised if NVIDIA will actually very quickly reclaim second most valuable company in the world. And you see, the difference to the first one is then not so much. So honestly, with all that momentum behind it, with the stock split happening right now, I wouldn't be surprised if we see NVIDIA very soon on the first spot as the most valuable company, not just in the US, but it's going to be the most valuable company in the world. And that alone will further fuel the excitement, people wanting to be part of it, right? It was the same when Apple was there. Everybody put their money into Apple because it was the most valuable company in the world. So I think in the short to midterm, that's really going to be a smart move by NVIDIA and in general company doing the stock splits if they have a strong fundamental business proposition behind, right? It's not that you have average company, you do a stock split and all of a sudden becomes more valuable. Let's not forget that you really invest into the long-term performance of a company, right? That's the important part, not short-term fluctuations. These things, they come and go, they bring excitement, they bring liquidity, but long-term, it's the company and what they're offering, and that's what you're investing in. So if you think that AI is going to be the future, chips are going to be needed for all kinds of AIs, right? And of course, right now, NVIDIA is in a very, very strong position to capitalize on that. Again, I don't know if they're going to be continuing to be the main player because right now so many others are coming on board. So I think competition is definitely going to heat up. But for the short to midterm, I definitely see them continuing to ride the wave, continuing to outperform. As I said, I wouldn't be surprised if they're soon going to be the most valuable company in the world. Do I personally think that 5 years or 10 years from now, they're still going to be the most valuable company in the world? I don't think so, because we've seen so many changes over the years of the most valuable company. Not so long ago, it was oil companies. Then we've seen Apple, then Microsoft, maybe NVIDIA. I don't know what's going to be 10 years from now. That's why personally I invest into the S&P 500. That way I will always bet on the winning horse. Whoever's on the top, I'm going to be profiting from it as a shareholder. And that's why I think it's very easy, set and forget it. And that way I will basically own all of these shares without having to pick a winner. I'll just dollar cost average and own all of them proportionately. Whoever does the best, I will own them. And I think that's the beauty of investing into the S&P 500. And if you want to learn more about it, then check out this video over here. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.